Hello, everyone. Thanks for being here with us today for our webinar. We'd like to welcome everyone here and our presenters. Just to go over a few housekeeping items, we are sharing this both on Zoom and on our Facebook Live. So if you are joining us through Zoom today, we definitely encourage you to ask any and all questions that you might have, and you can do so by using the Q&A button located in the bottom right-hand corner of your screen. If you are joining us through Facebook Live today, please feel free to ask those questions in the comment section below. We have team members monitoring both areas to make sure we're getting to your questions. I also just want to throw out there, as we all know, information is changing very rapidly day by day. So we will do our absolute best to answer any questions that you might have. But if there is a question we're unable to answer, we will make sure we can get back to you at a later date with what that final answer will be. So we'll be taking all Q&A questions at the very end of our webinar today. We have three amazing speakers who might be covering some of the topics that you have questions about. So please make sure you're filling those in throughout the webinar. And if there's anything we didn't cover, we will be sure to go over that again at the end. So with that being said, at this time, I would love to turn it over to Brenda McClellan.
Thank you, Molly. Good morning, everyone. I am Brenda McClellan, and my role at Traverse Connect is Director of Investor Engagement, and today we're delivering you advice from our friends at Rehmann, and I'd like to just very quickly introduce each one of our speakers here today. I'm going to start with Chris Singh. Chris is a principal in Rehmann's Ann Arbor office, and Chris also leads the firm's private equity and cannabis industries, and is a former member of the firm's board of directors. And we also have with us Sue West, also a principal at Rehmann, and she specializes in human resources. Susan's with a passion for uplifting human resources functions and leadership talent in small to mid-sized companies. She focuses on providing the expertise and guidance for addressing and improving HR business performance for clients, whether the need is complete HR outsourcing, payroll processing and employee handbook, personnel file management, policy development, anti-harassment training, dealing with an employee concern or larger organizational initiatives. She has the tools and resources through Rehmann that will provide value to fit each of their clients. And then finally, we have Tony Licavoli. Tony is the senior tax manager with Rehmann. He supervises tax engagements for clients in a multitude of industries. He's a member of the firm's International and Income Tax Accounting ASC 740 groups. And Tony also sits on the firm's tax reform subcommittee. He helps to develop content and tools to assist advisors and educate clients on the technical aspects of new legislation. And with that, we're going to kick things off with Chris. So we're going to begin talking about government resources and Paycheck Protection Program, PPP. Chris, go ahead and take it away.
Thank you, Brenda. Can you hear me all right out there? Great. Good morning, everyone. Along with Susan and Tony, I am first and foremost a business advisor at Rehmann. I have a large small business practice, and over the last few weeks, I've been working with my business owners, just like many of you today, to assess their cash flow forecast, their workforce needs and options, and to quickly optimize their relief funding available, which is much of what we're going to be covering today. Hopefully this information will be helpful for you. Next slide, please. We thought it might be helpful to first categorize the different types of government relief funding sources available out there. It's been fast and furious over the last several weeks. First is some state funding, and if you missed it, it's all right. It came and went. It was some small grants, but the MEDC administered some small $10,000 grants or smaller loans across 15 different economic development organizations. In your Traverse City area, it was administered through Networks Northwest. Nearly all of those applications have now closed, and the MEDC and the EDOs are sorting through the applications, and those are all under review at this point. They were small, they came in quickly, they went out quickly. If you were able to take advantage of it, great. If not, that's okay. There's bigger and better relief out there. Next slide, please. Also, the IRS is a source of funding relief, and Tony and Susan will certainly cover these in more detail and depth in their presentations. But from the IRS standpoint, there's relief in terms of payment postponements and filing postponements. There's relief in terms of employee retention credits and FICA tax deferrals. There's individual relief in terms of these individual rebate checks that have gotten a lot of media, and the retirement leniencies, which maybe haven't gotten as much media. And lastly, for the corporations out there, there is relief in terms of newly available amendments that could lead to refunds. So stay tuned for more information on that from Tony and Susan following my piece. Next slide, please. What I want to spend most of my time with you today on is talking about the SBA reliefs, and those still are a little bit confusing. They came out at different times. I would say the biggest one came out last, and that's the PPP program, which I will spend the most time with. But just to set the stage for what the SBA has available, if you have up in the upper right box, the SBA debt relief, if you have existing SBA loans, currently the SBA is willing to pay the principal and interest on those loans for you for 6 months. That has to be coordinated through your SBA lender, but that's a huge, huge benefit and source of economic relief for those current and existing SBA lenders. Secondly, there's the Economic Injury Disaster Loan, the EIDL. That came out a few weeks ago. At that time, most eligible companies thought that might be their biggest and best option. Many people raced to apply for them. It was a bit of a confusing process. I don't think any funds have been yet administered, but that was a loan program up to $2 million. The SBA Express Bridge loans there on the bottom, that relates to these EIDLs, and that was a way of getting some emergency grant money out to the EIDL applicants. So that is what a lot of folks raced for. Nonprofits were not eligible for that. And there was a requirement to be generally under 500 employees, which is a standard SBA rule. And this was a loan. It was a low interest rate loan, which is not quite as attractive as the PPP program. So when the stimulus bill passed on March 29th, inside of that bill was this PPP, Paychecks Protection Program. Today, it is by far the most attractive and popular relief program out there. Many of Raymond's clients have applied or are in various stages of applying. It carves out a good amount of the $2 trillion stimulus money that you heard quite a bit in the media. In fact, they're right now talking about extending the amount of funding to this program specifically because of its widespread use, need, and benefit. At a high level, it allows applicants to cover 2 weeks of payroll costs as well as some of the core infrastructure costs like rent and utilities. And then the best part about it is it has a forgiveness element. So after 6 months, you're able to apply for this to be forgiven as much as wholly, if at least 75% of it is used for payroll. I will certainly get into these details in the next slide. So next slide, please. First, wanted to share, I would touch that someone sent me a meme for accountants. Very, very rarely do people think enough about accountants to make memes for them. But this very much illustrates the fork in the road that many of us went through when this PPP program hit. This is tax season, probably your CPAs or yourselves were working on tax returns for you, and that came to a screeching halt because the highest need was getting this PPP funding out there. As I mentioned, the CARES Act passed on March 27th. There was a lot of speculation about how this loan would work in the calculation. On April 2nd, the Treasury published some final interim rules which clarified some things and fixed some inaccuracies in many of our understandings of what the CARES law read. And then Monday night, the SBA published their FAQs, which also clarified and again changed understandings of what many people had. Through each of these changes, the interested constituents, which are you business owners, your CPAs, your attorneys, and your banks, were all in various stages of keeping up and understanding these changes. So if you have been confused or frustrated, I certainly understand. I am extremely grateful that at Rehmann we have a large firm that collaborates well together, and we have deep connections into the banking and law and the law firms. And even with that, I'm not sure I'm showering every day. Last week was crazy, but I can certainly empathize if those of you are frustrated and feeling like you haven't gotten the answers that you need out there. I sympathize with the smaller CPA firms and the sole proprietor CPAs because it has been very, very challenging to keep up with all of the changes. So let's get into how it stands today. Next slide, please. This graph, these points here are inclusive of the SBA's frequently asked questions document that was landed on their site on Monday night. So to my knowledge, this is your most current information, but what we have all found is this is changing daily. The loan calculation itself, number one, let's talk about that. At a high level, it is 2.5 times average monthly costs, up to $10 million. Businesses and nonprofits with less than 500 employees generally are eligible. There are some exceptions for larger businesses. If you have restaurants and franchises, there are some further exceptions and complexities if you are venture capital or private equity backed. But for now, I will just say that generally less than 500 employees in the US qualify. Also, self-employed individuals are eligible, and their application period starts on Monday. This has been a welcome good news to many of our small business clients, those that file, maybe some of you out there, those that file Schedule Cs or receive 1099 income from others. Your relief comes in the form of filing for yourself. And those folks, if they are a sole proprietor, can get from about $20,000 to $30,000 depending on their costs. Number two, what's involved in these payroll costs, or how do you calculate them? First of all, I mentioned the 2.5 times average monthly calculation. The average is based on prior 12 months. This is something that has been clarified. The instructions to the SBA application themselves said 2019, but the law, the CARES Act, said the last 12 months. So there were lots of calculations out there using both, or sometimes a hybrid. On Monday night, the SBA came out and clarified that you can use either. And at the same time, they said if your application has already been submitted, don't change it. So you can use either calendar 2019 or the 12 months ended March 31st, 2020. After you get that measurement period set, what's included? Gross wages, health insurance, this is the employer portion of paid health insurance, retirement benefits, the employer portion of paid retirement benefits, and state unemployment costs. That's your starting point. And then there's some excluded costs. One thing to mention is one of the changes that came out on the April 2nd interim final rules is that independent contractors were explicitly excluded from the calculations of their clients, if you will. So each business should just be applying for their own employees' gross payroll costs. Beyond that, excluded costs are excess salaries over $100,000 per person. If you're a sole proprietor, a self-employed individual applying for yourself, only up to the first $100,000 of your self-employment compensation can be calculated. If you have any foreign, non-US employees, their compensation has to be subtracted. And if you have been paying any COVID-19 sick and family leave payments, which Susan will explain further, those are excluded too. And that is because of the principle of double dipping, which I'll talk about in a moment. With all these relief provisions out there, a general principle that they're all holding to is that you cannot ask for the same cost to be reimbursed or relieved more than once. Can't double dip. Third, what is the bank's role in all this? The bank's role is to administer funds. I'm not sure they all knew that a couple of weeks ago when we were hearing about the stimulus bill being put together. But their role, the money is coming through them. It is fully SBA guaranteed, and the SBA is paying these banks a small administrative fee to administer the funds. The advice to all of you, if you're interested in this program and haven't applied yet, is to work with your current bank, because it is quickest to use a bank that you have a direct demand deposit with, so that you are already queued up in their system for them to drop these funds into your account. With that said, there have been banks struggling out there. There have been banks that said, we're not doing this, or we're not doing it anymore. And because of that, there are banks that are accepting new client relationships. We're not going to put that list of banks here, but we can share that with you if you send that question through the TC Connect folks. Also, the SBA and the Treasury, Congress, frankly, have told the banks to assume a good faith assumption here, to assume that the applicants applying, the borrowers, are in need of this money, they are self-certifying, and to assume their payroll calculations are correct. Now with that said, each bank's internal quality control process has differed. I mentioned many are struggling. Some have not kept up with the calculations and have been sending back calculations incorrectly. Some of their sites have crashed. Some of them, like Wells Fargo, have stopped. And the SBA site has crashed also. What I can say is all the banks are trying. We've never known bankers to work on weekends or late evenings like CPAs do this time of year, but they're all working late. And so I've never had so many weekend and late night calls with bankers in my career. They are all trying. If your bank, for whatever reason, can't process it, there are new banks willing to take on new relationships, but just know that that's going to be a bit of a delay because they have to go through their due diligence period to set you up as a customer. They will probably be taking care of their current customers first. Number 4, what is this forgiveness process? That's what makes this program, frankly, more attractive than most of the others out there, because this might not just be a low interest loan, this might be forgiven. The forgiveness process itself, that application is not fully known. So what we're doing here is interpreting what's in the act and what's in some of the follow-up guidance we've gotten. So what we know today is that the forgiveness process is going to be measured initially on how you use these funds for the 8 weeks following your loan receipt. So 2 months of expenses. You can use up to 20% of these funds for mortgage interest or rent, depending on whether you own your facility or you rent your facility, and utilities. And then at least 75% should be used for payroll costs in order for this to be fully forgiven. There's also a provision that each person's employee wage shouldn't decrease by more than 25%. Are there a lot of questions about that? Yes, that's a bit of a complex and vague comment right now in the law. And then with all of this, currently, there is a rehire exemption that even if as many businesses out there, there's a stay-home order in Michigan, obviously, so not everyone thinks they can realistically keep their workforce busy for the next 8 weeks, even with this money. That is okay right now. If you are able to rehire and restore your full-time equivalents by June 30, 2020, that exception applies and you should be able to get the payroll piece forgiven. After all that is said and done, it's not a cliff here. Some of your loan can be forgiven, all of it can be forgiven. Once that happens, so we're talking 6 months out, when the application is made, you will be formally applying through your bank. The first 6 months of these payments of your loan is essentially free and the payments are deferred. And then once the unforgiven portion, if any, is determined, that will be converted through your bank to a 24-month 1% loan. That is the current understanding and process for the forgiveness. One thing I would advice I will give you all, which is the advice I've been giving my clients over the last couple weeks, is to use this cash flow the same as you would for any other working capital of your business, not to get too hung up on thinking you have to bring people back if you have no work for them. to keeping your precious cash flow in the business. Worst case, if you just have it for 6 months and on the unlikelihood don't meet this forgiveness calculation, you've had this cash flow for 6 months to help your business survive. So please don't let this alter the cash flow and working capital decisions you're otherwise making. The last comment I wanted to make is about double dipping. This overriding principle that of all these reliefs out there, you can't ask for the same costs to be covered more than once. I've mentioned the COVID-19 sick and family leave payments already. And again, Susan will talk more about that. This EIDL loan is probably the biggest complication of that. For those people that had already applied for the larger $2 million disaster loan, if they put in their application that they were going to be covering payroll costs, essentially the same payroll costs that they're hoping the PPP loan will forgive, you can't do that. You can't double dip. Because of that, most of our clients have put a pause. If they are eligible for this PPP program, most of them are. They've put a pause on the disaster loan. Just because you applied, you probably haven't accepted yet. I haven't seen that many of them have made it all the way through the process and funded. But most have put a pause on this to get their PPP forgivable loan application submitted, because that really, if you apply, is a no-brainer. And it is the better and most attractive option, that relief option that we see today. All right, so with all of that, I want to pass it over to my colleague, Susan West. Susan is our human resource champion with the firm. We couldn't get through this without her, and you are all very lucky to have her time this morning. She's a busy lady at Rehmann. Susan, take it away.
Good, thank you, Chris. I think that one of the biggest things I want to say, as Chris has already somewhat suggested, is don't go it alone. There is just so much information here that it becomes a little overwhelming. So let's get started. I first want to talk about the Families First Coronavirus Response Act, also referred to as FFCRA. I'm going to be talking about two of the benefits under that. One is the Emergency Family Medical Leave Expansion Act, and the other is the Emergency Paid Sick Leave Act. And so there's been 104 billion, big numbers here to really help our employees who are totally impacted by this COVID-19 pandemic. What we know is that these two potential leaves or actual leaves are over and above what an employer already offers. They must be paid, so you as the employer can't make a decision not to offer this to employees, or you'll be subject to the Fair Labor Standards Act audits and fines. So there's actually the Emergency Paid Sick Leave Act, which offers 80 hours of paid leave to full-time employees. And then we also have the FMLA Plus, sometimes as it's called, where it gives employees 12 weeks of leave for actually one very specific purpose. And so I'll go over both of those here in a moment. We probably all know by now that all employers are covered if they have 500 employees, fewer than, or at least one employee. And there is some guidelines around those under 50 employees where you can provide an exemption, and certainly there's some guidance under the DOL Q&As that can give you more detail if you feel that's your case. So let's go to our next slide. These two acts were effective as of April 1, 2020. There were actually 5 different levels of clarification between March 18th when it was signed, April 1st when it was effective, and April 6th when the final rule was finally published. The DOL has actually given guidance in the form of 79 questions with answers, and that was more or less finalized just this past Monday. There's a non-enforcement period, so from March 18th through April 17th, as long as an employer has been making reasonable good faith efforts to comply with the act, you're good to go. However, come April 18th, it's going to take us to a whole nother level of guidance by the federal. So one of the things that's very obvious is the posters that the federal government are asking that we actually post and provide to our employees. That actually has its own frequently asked questions, and we're asking that those employers get it out to their employees. It was issued on March 25th, so please make sure you get that posted both internally and externally to your work from home folks. Okay, so one of the biggest questions that came out and a lot of confusion was initially, when would this act, even though it's effective April 1st, be retroactive? And the answer to that was no. So from April 1st is the only time that the employees could have a qualifying reason for being eligible for the two different acts. So let's move to the next slide. So the first one I'm going to talk about is the Emergency Family Medical Leave Act. And this expands for one coverage only. And that particular coverage is for a qualified employee who is unable to work or telework due to the need of a son and daughter under the age of 18, where the child's school or place of care has been closed due to COVID-19, or the child care provider is unavailable due to an emergency related COVID-19 shutdown. So as we talked about, there is 12 weeks available. And so if we can go to the next slide, you have to be eligible and working for the company for a minimum of 30 days. And the other piece to the 12-week period is the first 10 days are exclusionary. So what that means is you do not have to pay it. However, if that employee has PTO available through their employer program, they can use that for the 2 weeks, or the paid sick leave can be applied. Those 80 hours could also be applied to those first 10 days. From there, they have another 10 weeks, and that individual would be paid 2/3 of the regular rate up to a maximum of $200 per day, or $2,000 in total. Oh, so, yes, that's correct. So if we continue on with this, we have the idea that there's intermittent leave, so the employee can make a request to use this time over that 12-week period for on and off schedules. And so I just want you to know that's an employee and employer discussion, and you can certainly work with them based on the work schedule you might have, especially if there's a telework scenario in place. So a lot of conversation should happen when you're talking to the employee around use of the Family Medical Leave Act for this one particular reason. So let's go to the next slide, please. Now, the next 3 slides I'm not going to spend a lot of time on, but I want you to know that there's a lot of discussion and clarity that's come out around how do you define full-time and what does that mean, especially when there's a further interpretation of when a part-time employee might be eligible for these different leaves. Next slide. And there's also been some clarification around the definition of a child. So is it my child or is it somebody else's child? And so I would encourage you again to be aware of this. So as you're talking with your employee, you can make sure you understand what are the provisions under the law and how do we help our employees understand what they're eligible for. There's such mass confusion around what people can be eligible for and what they can't. And I really encourage you to go back to the questions for the guidance so that you can make sure you're asking for the kind of documentation that's needed. which is the next actual slide. When we know that there was some confusion around this, the DOL provided one set of guidelines, and then they came back and sort of made it less restrictive, I guess would be, or demanding. So for the FMLA, there's basically 4 things that are needed: the employee's name, the dates for which the employee is requesting leave, a statement of the reason for the leave, and a statement that the employee cannot work or telework during the period. And then there's some additional information required if it's actually related to the school or daycare closures. And so let's be clear about what that's needed. There's also documentation that you should be keeping in order to have that audit trail for your payroll tax credit. And that kind of documentation should include things like how the amount of the leave and what was paid was determined, what wages were used and how was that determined, and then copies of the actual IRS forms. And so all of these should be kept for at least 4 years, but please refer to the guidance to make sure you're doing what's necessary as the employer. Okay, so next slide. Job restoration. So there's some specific guidance around what's called the Family Medical Leave Act expansion, or as, and you're seeing in this slide, the plus represents that. And so I want you to be aware that once again, as you have employees out for a length of time, what is your responsibility? Because it may in fact be somewhat different than the traditional or classic FMLA. So next slide, please. So now a few moments on the paid emergency paid sick leave act. This is where you get 80 hours of sick leave. Now in this particular case, you have 6 qualifying reasons, and they're stated here. The first one, the employee is subject to a federal, state, or local quarantine or isolation order related to COVID-19. This created a huge amount of confusion initially because we felt that the state stay at home or shelters were a qualifying reason. And as it turns out, with further DOL guidance, that was not the case. In this particular case, the employee has to have a quarantine request or isolation request as designated by a healthcare provider. And that really falls into then 2 and 3, which is where the employee has been advised by a healthcare provider to self-quarantine due to concerns related to COVID-19, or they're experiencing symptoms of COVID-19 and seeking medical diagnosis. Now, this has gotten also a lot of confusion because people are deciding to unilaterally self-quarantine, all for their own safety or for the safety of family members. However, the DOL has made it very, very clear that if you unilaterally decide to self-quarantine for an illness without medical advice, even if you have COVID-19 symptoms, you are not going to be eligible for the leave. So we are encouraging to help educate our employees because we want to make sure that people understand their responsibilities in seeking out the medical advice so that then they can provide the kind of documentation and communication to you as the employer. Now on this particular item number 6, I'm going to jump to number 6. That particular qualification is not fully defined. It's more for a holding spot for any future symptoms that might show up as a result of COVID-19. So that's an area where there's no more clarity than the day the original information was provided by the DOL. Number 4, 5, and 6, those are paid at a different level than 1, 2, and 3. 1, 2, and 3 have a 511 maximum per day, and 4, 5, and 6 have a 2/3 of the regular rate, or a $200 maximum per day. There's clarity in the Act on what the how you can calculate the regular rate, so please make sure as you're providing or preparing for your payrolls, you understand that. And lastly, I want to share with you that this particular act is available to an employee with no minimum employment duration. So the day they hire could be the day that they could be eligible if they have one of these qualifying reasons. Next slide, please. So there are tax credits. These tax credits are only after the employee has used it. It's 100% payroll tax for the wages paid up to those maximums. And it's actually calculated on the, you pay it up front, obviously, and then it comes back to you by putting the equal amount of the stumbling over my words, qualifying sick or child care leave that it paid, and you would apply that against the employer payroll taxes that you have due at the end of the quarter. And so the very first quarter that this would actually become eligible for would be the June 30th second quarter filing. Okay, the next slide, please. So here's where it gets a little complicated, because under the CARES Act, we have expanded reasons that were provided for eligibility for unemployment, and that was under the Pandemic Unemployment Assistance. There they identified that the federal government was providing to the states the eligibility to expand benefits under the COVID-19 related reasons. I'll share those on the next slide. That there's an additional 13 weeks of eligibility, so now we could have up to 39 weeks total. It's adding a flat $600 to the weekly benefit amount, and a lot of conversation around that, so I'll be coming to that in a moment. And then the federal government also encourages the states to loosen their 1 week waiting period and the looking for work requirements. So here in Michigan, they had already relieved the looking for work requirement, but now with Governor Whitmer actually putting in the request on March 30th to the federal government and getting the approval for that for these expanded benefits, now the 1 week period would also be applicable here. The waiving of the 1 week period would also be applicable. And then, of course, they are looking forward to the states encouraging employers to use the work-share programs. Okay, let's move on to the next slide, please. So here are the 9 reasons. These 9 reasons are ones that were already, for the most case, already available. The biggest difference is that they've extended these to individuals who otherwise wouldn't be eligible. Self-employed, independent contractors, gig workers, part-time employment seekers, and those who might not have been working long enough to have the full 5 calendars of wages under their belt. So not only did they expand the who that was eligible, but they now expanded the reasons. And you can look at like 7, 8, and 9 there are probably the ones that are a little bit more unusual. They were scheduled to start a job but were unable to do so as a result of the COVID-19. They become a major support for a household because the breadwinner in the household has died of a direct result of COVID-19, or they've quit their job as a direct result. What the government, the federal government has said is it's now up to the states to implement these 9 criteria and the expanded weeks and the of the waiting period, all of that, that goes right back to the states. So state of Michigan, for example, Georgia, they're all putting in their own requirements, and I'm going to talk a little bit more about that. So let's go on to the next slide. Now this is that 600 flat payment. There was just guidance that came out over the weekend that identified that if an individual is eligible to receive at least $1 of underlying benefits for that claimed week, the claimant will also receive the full $600. If the individual's earnings for the week exceed the weekly benefit amount, then that individual receives 0 in regular unemployment compensation benefits for that week. They would also then not receive the 600. So once again, this is coming back to the state to make the determination if an employee is eligible for the typical state benefit. And if they are and they receive $1, then the employee will receive 600. If the state determines under their guidance that an employee is not eligible, then the employee will not. Next slide, please. So the reason why I bring this up is because I want to encourage any of you that have out-of-state employees that you really get familiar with the specifics of that state. For example, I highlight Georgia, and that's because right now Georgia is requiring employers to file the unemployment benefits on behalf of the employees that have COVID-related 19 excuse. It's becoming increasingly more demanding on the state's unemployment centers to accommodate the millions that are applying. Many have moved all directly to an online application. They're getting denials. Employees are getting denials. Employers are getting the denial requests for information. So there's a lot of mass confusion around this right now. The biggest recommendation an employer can make is tell their employees, please go apply. It's up to the state to determine if you have a qualified reason. We're going to be in communication with the state. However, you need to follow the state guidelines and the state application to determine if you have a particular qualifying reason. Okay, next slide. So this is the biggest concern we're seeing right now. We've already had employers who have had employees out on a temporary shutdown and now are calling them back to work. And there's been a lot of questions about, well, I want to stay on unemployment. I don't want to return. Our employees are now saying, I have, during my time off, I just was exposed and I don't have symptoms, but I need to stay home because I'm fitting the 14 days under the shutdown order that Governor Whitmer just put out on April 3rd. So mass confusion. This is very clear. If you have work for an employee and they are identifying that they do not want to return to work, then that employee has to make a decision. You have work, that's how you're going to report it to the unemployment when the unemployment asks if the employee was eligible, and you're going to identify on that request that you were asked them to come back and they refused. Now, Michigan's court order or executive order just said we cannot retaliate, discharge, or discipline an employee who is staying home due to COVID reasons. So I would get very clear on your process for how you're going to communicate with employees. And, you know, having a step-by-step on how this will all be handled and who's going to handle those conversations is critical right now. You want to make sure you have documentation on when they leave, when their return to work date is, when you had telework options, when you had no work available, when you were able to bring them, wanted to bring them back. So documenting all of that, making sure that you understood why they said they could not, and if they qualify for an unpaid reason to stay home under the 2020-36 order, and or what date then do those stay at home days end and the employee again is able to return to work. So a lot of time spent to try and understand what steps we as an employer need to put in place. We want you to stay home if you're sick, but we also want you to understand your responsibilities, not only to state unemployment, but to us as an employer when we have work available. Next slide. Wow, okay, so lots of questions. I'm still coming forth on that. We have some great frequently asked questions that are available via our business advisors, and so we certainly look forward to helping to answer those. So on to Tony.
All right, thank you, Susan. So we're going to be moving through some of these provisions pretty quickly because we want to make sure to save at least a couple minutes at the end for some of the Q&A. So whenever we have a stimulus package, one of the first areas the government's going to go to is going to be the tax code for relief. And just to step back a little bit and summarize kind of everything that everyone's discussed and where we're actually at, we've had 3 COVID-19 bills pass in the month of March. Now, the first one you probably don't hear much about. That was actually the first week of March, and it was really just a bill to actually fight the virus. So it included things like funds for different types of vaccines and development, and also R&D as well. Then in the middle of March, we had the second bill, or phase 2, and that is just what Susan discussed. That is the Families First Act. And then finally, we had the, well, I shouldn't say finally, because they are talking about a potential phase 3.5 or phase 4, which would include additional stimulus funding, including additional funding for the PPL program that Chris talked about. But we had phase 3 back at the end of March, and that is what's known as the CARES Act. And this included items like the PPLs that Chris went over, and also included some of the significant tax provisions that I'm going to cover right now. So if we can actually skip over to the next slide, I think everyone knows at this point that the deadline has been postponed. And let's talk a little bit about a couple of the individual tax provisions. So Chris had mentioned that the recovery rebate is the one that's getting most of the attention, at least in the tax provisions in the news, and that's definitely true. So how does this credit, how does check actually work? And it's essentially a credit, the 2020 tax credit that you receive from the government in advance by them either depositing money directly into your bank account or by them sending you a physical check in the mail. And the credit is limited to, or the maximum you can get is up to $1,200 for a single filer, and then $2,400 for a married couple. But you can also get an additional $500 per qualifying child, and this is generally going to be any child who's under the age of 17. So if you had a family of 4, assuming that your kids were qualifying children, you would get up, potentially up to a $3,400 check or deposit in your bank account. Now, it is subject to phase outs based on the taxpayer's adjusted gross income. So for a single filer, by the time you get to $99,000 of adjusted gross income, you won't receive any benefit. And then basically double that for a married filer. By the time you get to $198,000, you would not receive a benefit, or you would not receive any credit. So I said in the beginning that this is a 2020 tax credit, and we haven't filed any 2020 tax returns yet, obviously. Most of those haven't filed 2019 returns. So how are they actually going to determine what to actually send you? Well, they're going to look at your last filed tax return. So if you filed a 2019 return already, they're going to use that. And then if you haven't, they're going to look at your 2018 return to determine how much to actually send you. And then one other thing I want to point out before we move to the next slide is that the IRS released some FAQs on this area. And one of the things is if you do not use direct deposit when you file your tax returns, they're going to put a system in place where you are able to actually submit your bank information online. So otherwise, you don't have to actually wait for that check to actually come in the mail. So we're going to skip over that next part. If we can move on to the next slide. Retirement plans. The only thing I want to say here is there are a couple provisions that are are available if you absolutely need to take out some cash. Obviously, retirement plans are one of those last resort options, but if you are considering it, I would definitely reach out to either your CPA or your financial advisor to really determine what the best approach for withdrawing those funds would be. And at the bottom of the slide, a couple small provisions. Anyone who does not itemize deductions on their 1040 will be allowed a small contribution deduction up to $300. And then for anyone who does itemize, they have lifted the temporarily lifted the income-based limitations for contributions. So they are encouraging people to donate by making it easier to actually receive a tax benefit in the actual year of donation. So moving on to the next slide. Now we get into some of the business tax provisions. An employer retention credit is a pretty significant one. And this is a completely separate payroll tax credit than from what Susan was discussing. And it is a refundable payroll tax credit up to 50% of eligible wages paid by an eligible employer to an employee. So let's quickly define a couple of those terms. What is an eligible employer? Well, you just need to have operations that were impacted by a COVID-19 government order. So for example, if we have a restaurant that is in a state with a shelter-in-place order, well, they may be doing, let's say, carry-out, but their operations still have been impacted. So you don't have to be completely shut down. There's a partial shutdown standard. And if you don't meet the government order test, there's another test that you can use, and that is you have to have a greater than 50% reduction in quarterly sales or quarterly gross receipts measured on a year-over-year basis. Now, there are some restrictions here. And the biggest one is if you do apply for one of the 7A loans or one of the loans that Chris was referring to, the PPLs, you are not going to be eligible for this credit. So that is an eligible employer. What about eligible wages? If you had 100 or fewer employees, all wages are going to be qualified. So it's a very simple test. I have 100 or fewer employees, I just take all wages and they're going to be qualified. But if you have greater than 100 employees, only the wages of employees who are either furloughed or face some type of reduced hours are going to qualify. So if we go back to our restaurant example, we are partially shut down. We're still doing, let's say takeout. I have an employee that usually works 40 hours a week, but because of the partial shutdown, they're still working, but they're only working 10 hours. Well, that 30-hour difference, if I pay them for that, if I pay them for a full 40-hour week, that 30-hour difference is going to qualify. And then the biggest item on here, eligible wages are capped at $10,000 per employee. So if the credit is based off of 50% of eligible wages and we cap it at $10,000 per employee, then really the credit is capped at $5,000. So we're going to move on from this credit. And I just want everyone should know that there are certain restrictions on when you can use it, and basically they want to prevent double dipping of being able to utilize other credits and also use this one as well. But sticking with payroll, employees are allowed to defer paying basically a portion of their employer payroll taxes, and that's going to be the 6.2% Social Security, and then you repay that amount over 2 years. But the key is if you do utilize a PPL loan and there's a forgiveness portion of that, you are not eligible to defer payroll taxes as well. On to net operating losses or NOLs. Again, because of time, I don't want to get into all the details here, but basically net operating losses, you used to be able to carry those back to prior years. Then that carryback ended, and now it's back because of the CARES Act, and not only for 2020, but also 2018 and 2019 as well. So that is retroactive, which means there are going to be opportunities to file some amended returns or some carryback forms if you had losses during these specific years. And that also applies to the excess business loss limitation for individual taxpayers as well. And it goes back to 2018 as well, so it is retroactive too. So we're going to skip over to the next slide. And for business interest expense limitation, just know that that limitation has been increased if for some reason your business was limited to take that deduction. but there are specific rules for partnerships as well. And then I want to end here with qualified improvement property. So quick background here, when the Tax Cuts and Jobs Act was enacted back in December of 2017, there was a mistake made with the wording on one of the provisions that turned qualified improvement property, and we'll talk about what that is, into 39-year property, which by default made it no longer eligible for bonus depreciation. And this was known as the retail glitch because it, in general, affects retailers, restaurant business, franchises like that significantly. So instead of, because of this glitch, instead of getting an immediate write-off, you had to depreciate that asset over 39 years, which obviously makes that deduction a lot less valuable, taking it all in 1 year versus spreading it out over the next 4 decades. So this has been fixed, and the effective date is back to December 31st, 2017, which means, again, there's another opportunity to either amend returns or file an accounting method change for 2018, 2019 to actually generate some cash refunds there. And let's walk through a quick example of how this would work. Well, first let's talk what is qualified improvement property. And you can generally think of it as internal improvements to a non-residential building. That's key there. It can't be residential. And those improvements can't be structural in nature. So sticking with our restaurants, let's say we have a restaurant group that decides to do some remodeling back in 2018. They incurred a cost of about $1 million for those internal remodels. So that $1 million in 2018 has to be capitalized and depreciated over a 39-year period. So that's going to be only about maybe a little more than a $25,000 deduction each year over the next 4 decades. But with the new tax law change, you can amend or file an accounting method change, depending on what procedure you go under. You can amend those 2018 returns, and then you'll have to amend the owner's returns as well if you are a pass-through entity, and take that $1 million deduction for that actual year. So assuming about a 30% tax rate, you can actually receive a refund of, based on our $1 million example here, of slightly less than $300,000 on that federal side, and then not including any state impact as well. But so it's never going to be as simple as easy as that. You know, there's a bunch of things you have to take into account. Number one is the fees for analyzing qualified improvement property to determine what actually falls under that category. Also, the cost of amending returns, the cost of amending owner's returns, and then also the potential cost of filing an accounting method change. But we do think there could be a lot of opportunities here, especially for our restaurants, franchise groups, retailer clients, and then really any CapEx heavy company. We think there would be a lot of opportunities here as well. So with that, I'm going to turn it over to Molly so we can get in a couple Q&As here.
Sounds great. Thank you all so much. And just really quickly on the screen, I do want to make sure I put Laura Oblinger's information up. Laura is in the Traverse City office with Rehmann. So if you have additional questions, you can definitely reach out to her, or you can reach out to anyone on the Traverse Connect team, and we will make sure we get all questions over to our presenters as well. So I'm going to stop sharing my screen here so I can make sure I get to some of the great questions that were being asked. Our first one actually came in a little bit early. It came in yesterday. And the question was, I've been told a local employer inquired with the IRS about reimbursement under the Expanded Family and Medical Leave Act, that they were not eligible because they did not have an FMLA policy in place. This employer is under 50, so they previously would not have been required to offer FMLA. Is this a misunderstanding, or do small employers need to get policies in place before someone needs the leave? Oh, Susan, I think you are muted if you are referring to this.
We want Susan to answer this for sure.
It is true. If you were under 50, you most likely did not have an FMLA policy in place. For this particular category or qualifying need, we would recommend you put a policy in place so that it's clearly understood But just because you didn't have a policy in place before does not mean you shouldn't, does not mean that you aren't required to offer it under the law now, whether you had a written policy or not.
Perfect. The next question is, if I'm fortunate to receive the PPP loan, can I postpone when it's put into my account? My dental office is closed with no payroll currently. I don't know when we can open again, and I'd like to utilize the 8-week forgiveness window.
I can answer that. Can you determine when the funds are deposited into your account? No. You're certainly not the only one that's concerned that this 8 weeks won't match up very well with the forgiveness period. The first hope may be that if you're able to restore your FTEs as of June 30th, that forgiveness calculation will be restored. And then worst case, to be honest, if you're not able to bring your workforce back even by June 30th, at least you have had this cash flow to help your business survive for the period. And also remember that up to 25% can be forgiven if it's used for rent, mortgage, interest, or utilities.
Thank you, Chris. The next question is, the organization I represent is a 501c8. I have been told this does not apply to them. Do you know that to be true?
Afraid so, at least according to the interim final rules that were published by the SBA on April 2nd. I looked that up when I saw the question. On page 6 of that, it does define the nonprofits as 501c3s, as well as veterans organizations, which are 501c9s, as well as tribal business concerns from a different IRS section. So 501c8, I believe that to be true, is excluded, unfortunately.
Perfect, thank you. Our next question is, can you further explain recommendations about bringing employees back under PPP? If no work, how to entice employees to agree when they might get more from unemployment?
That might be a mutual question with Susan and I, but you are not alone in that concern, especially if perhaps your employers are getting paid better under the current unemployment provisions, or they think they are. So I guess I'll let Susan answer that properly. Next.
Yeah, sure. So one of the things we need to be clear about, because some employers have put employees on a temporary shutdown, they've also extended their benefits. So their benefits could be end of month plus 1 month, which means it could take them out to April 30th, or those being laid off in April, maybe May 30th. So anytime an employee that does not come back and there's work to be done, then they now are in jeopardy of losing a benefit and or being ineligible at the state level if they don't meet a qualified reason. It will be up to the state to make that decision, not the employer, because the employer has work. So the employer wants that employee to come back. And I think that's an education piece. What we do know that if it's going to happen when the order is lifted in the state of Michigan, we're going to be dealing with this question probably daily. But if there's, we have to state to the employee, we have work for you. If you don't come back because you feel you have a COVID-related reason, then you have to provide us documentation. At that point, that documentation will identify what kind of leave you might be eligible under the employer. But if you are making a decision not to return to work, you have no COVID-related reason that's qualified, then it's up to you and state unemployment to figure out what your status is. What we do know at some point, there could be the UIA investigating all of these self-certifying situations. And then at that point, an employee may be responsible for a payback if they find that there was a fraudulent application and payment of unemployment because their self-certification wasn't real.
Perfect, thank you, Susan. We had a question come through the chatter. You said that during the exclusion period that sick leave may be applied. My understanding is that it must be applied. Can you explain?
Sure thing. So this is actually given in the guidance on, I believe it's question number 7 in the DOL. And there's one very clear reason why they've stated it as maybe, and that is because the employee may have already used their paid sick leave for a true paid sick leave reason, not just the expanded medical, family medical leave provision of no childcare or schools closed, so I can't come to work to take care of, because I need to take care of my child. So people may have already used their paid sick leave, or the employee and the employer might decide to use their other extended benefits of PTO or other kind of paid time. So that's the reason why it's a maybe scenario.
Perfect. Our next question is, the EIDL application had no place to request a specific loan amount. I checked the box for $10,000 right now with no other amount requested. Do I need to pause that loan request?
No, and I actually have a good answer for that. Hopefully when you apply for the PPP program, you will use the latest application. That's an application that has an expiration date of 9/30/2020 in the upper right corner, because when they issued a second version of this application, they specifically put a box in there in order to request payment of your $10,000 forgivable EIDL loan along with this paychecks calculation. So you will get it in addition, and it should, if it works as designed, it should be given to you with your PPP loan as well.
Perfect, thank you. And it looks like we have 2 more questions here. So the next question is, how are companies handling employees who personally can only work reduced hours who want to apply for unemployment? Do companies have to apply for the work share program?
So that's probably in my bucket. So once again, employees can go apply if they have a reduced work schedule. What's going to drive that is how much income or how much were they paid in that week, and how does that affect their weekly benefit amount. So there may be times when the employee is making more even under a reduced work schedule than the weekly benefit amount they would be eligible for. So it's really apply. Unemployment's going to do their calculations and determine whether or not you're eligible. There is some great guidance about the work share programs on the Michigan UI website, so I encourage you to take a look. They have a pretty well-defined program with some good frequently asked questions out there. There are also some basic requirements, so I would make sure you review that. Try and get in touch with a representative to make sure you're meeting the criteria for a work share program, but many of our clients are considering that option. And then lastly, I just want to circle back to my other answer, which sort of ties to this too. We certainly, because of the executive order 2020-36 from Governor Whitmer, we want to make sure that we are not making a decision to terminate an employee right now who's refusing to work or claims that they have a COVID-related reason. You want to make sure you get some employment law counsel involved, because it can be a very integrated decision with a lot of variables. And I want to make sure that we're getting good guidance from those that are really there to interpret the law. We're just here to provide some general guidance, but they're the ones that can give you that kind of legal advice.
Perfect, thanks, Susan. Can an employee who is being paid PPP compensation by one employer while the other company is shut down work for another company that is hiring during this 8-week period?
That might be a combo answer for us, Susan. Yes, although the burden of that PPP forgivable loan is on your employer's side, and they should be good faith certifying that they are using it to keep their people employed productively. So that's a little bit of a slippery slope, but on the employee side, if you have that work, I don't think anything is stopping you unless Susan says so.
And I'd never say so. No, we recognize that right now, many employers who might have you on a temporary shutdown, temporary leave, because they have no work are waiving I mean, they can't ask you to stay with them. They're seeking, oh goodness, waiving the opportunity for you to seek other employment. They recognize you got to do what's best. So that would be your choice. Again, the employer would be responsible for either retaining you as the new employee under that plan, or you're returning back to the employer that had you on temporary shutdown. That would be the employee's choice. The rest of it would be up to the employer to how they handle your return.
Perfect. And it looks like our very last question for today is, are small business owners eligible for unemployment benefits right now?
So it's sort of dependent on your status. If you're paid by the company and receive a W-2, possibly. I would encourage you, it's the state unemployment, again, makes those decisions as to whether somebody who has applied is eligible. We know that with the expanded reasons right now for unemployment eligibility, there's more discussion around self-employed and independent contractors. So my guess is possibly.
Perfect. All right, well, it looks like that's all the questions that we had for today. Again, I do want to encourage everyone, if you have additional questions, follow-up questions, maybe something that you thought about at a later time, please feel free to email myself or anyone else in the Travelers Connect team or Laura Oblinger. We will make sure we get your questions sent over to our presenters here today to help you in the best way that we know how. And again, I would really like to thank the Rehmann team, Tony, Susan, and Chris for your expertise and for being with us here today. I hope everyone has a fantastic day. Enjoy the rest of your week, and we hope to see you at our next webinar next Wednesday. Thanks, everyone.
Bye.
Bye.